So something really weird happened in the stock market on December 11th. You had all these headlines screaming about all-time highs, right? But at the very same time, the tech sector was, well, it was quietly bleeding out. It was a true tale of two markets. So let's break this down and figure out what on earth was going on.
And yeah, this split, this divergence, it really caught everyone off guard. I mean, you have the broader market throwing a party while this huge storm was just brewing over in the tech world. Just bizarre.
Okay, so here is the core of the whole puzzle. On one side, you have the Dow and the S&P 500. We're talking the heart of the US economy here, hitting brand new all-time highs. Champagne corks popping, you know? But then, look at the other side. The tech-heavy Nasdaq, it fell. I mean, that kind of split is super rare, and it tells you there's some kind of powerful underlying tension pulling things apart.
So that's the big question, isn't it? What could possibly be powerful enough to literally split the market in two like this? Well, the answer, and this might surprise you, it all comes down to a single company's earnings report.
And that brings us to our catalyst, the company that kicked this all off. The trigger for this whole tech panic? It came from a bit of an unexpected place. The cloud computing giant, Oracle. Yeah, their latest results, they sent an absolute shockwave through the entire AI world. Now, you gotta understand, Oracle has been a huge player in this whole AI boom. I mean, they've been spending like crazy to build out all the infrastructure you need to power artificial intelligence. And up until this point, investors were loving it. They were rewarding all that spending, but that all changed with this one report.
Okay, let's look at the numbers here, their Q2 report card. So revenue, missed estimates, but just slightly. Future guidance, a little weak. But honestly, that wasn't the headline. No, the real bombshell, the thing that made everyone's jaw drop, was this number down here, their capital expenditure, or CapEx, as they call it.
$15 billion. That's a number. Oracle announced they were upping their planned spending for the next year by an extra $15 billion. I mean, that's way more than they estimated just a few months ago. They were just pouring money into AI, and for the first time, Wall Street looked at that and got really, really nervous about the price tag.
So, this brings us to the big question, the AI bubble question. Because Oracle's bombshell, it didn't just tank its own stock, nope. It sparked this much bigger, much scarier question that, let's be honest, has been kind of lurking under the surface for months. And that question is this whole AI rally just a giant bubble?
See, that fear just became contagious. The thinking was, whoa, wait a minute. If a giant like Oracle is spending this insane amount of money with no clear idea of when they'll make it back, what does that mean for everyone else? And just like that, the selling started to spread, from Oracle to its partners, its competitors, the whole shebang.
And man, did the dominoes fall fast. Oracle itself plummeted over 10%, but it dragged a bunch of others down with it. You had NVIDIA, the undisputed king of AI chips, it fell. Then Micron, the memory chip maker, it fell too. And Broadcom, a huge hardware supplier. Yep, down it went. Suddenly, this wasn't just an Oracle problem anymore. This was an AI problem.
This sell-off, it was like pouring gasoline on the fire for skeptics, and it really amplified the voice of guys like Michael Burry, you know, the investor from The Big Short. He'd been warning for a while that this whole AI boom felt eerily similar to the dot-com bubble back in the late 90s. You know, where you had massive spending, insane valuations, and then, eventually, a massive crash.
So here's the fear, boiled down. Are these companies spending billions and billions on AI with no clear path to actually making that money back? The whole conversation shifted. It wasn't how much can you spend on AI anymore. It was, okay, great, but how are you going to profit from it? And with no clear answer to that question, the fear just kept growing. But here's the thing, that's only half the story.
Let's get to the other side of this, the Federal Reserve's move. Because while the entire tech world was freaking out about spending, there was this other, even more powerful force at play, and it was lifting up the other side of the market. That force, none other than the U.S. Central Bank.
And this is what made that day so incredibly weird. You had one part of the market just sinking under the weight of its own spending, while the rest of it was floating higher and higher on this big wave of cheaper money. It's a total contradiction.
So check out the timing on this. Just one day before Oracle dropped its bombshell report, the Federal Reserve made a huge move of its own. They cut their key interest rate, one of the most powerful tools they have to steer the entire economy.
So how does a rate cut actually boost the market? Well, it's pretty straightforward. The Fed cuts rates, right? That makes borrowing money cheaper for basically everyone. Companies, you, me. And when borrowing is cheap, people and businesses are encouraged to spend more. All that extra spending gives a nice boost to the broader economy, and that usually acts like a big tailwind for the stock market.
And that's exactly what happened. This cheaper money sent investors pouring into all the non-tech stocks. We're talking the big, stable, blue-chip companies, banks, retailers, healthcare giants, you name it. And that is what pushed the Dow and the S&P 500 to those record highs we talked about at the very beginning. Mystery solved? Well, half of it anyway.
Okay, so now the market's getting selective. Let's put all the pieces together. On one hand, you've got the tech sector, totally terrified of overspending on AI. And on the other hand, you have the rest of the market, celebrating this new era of cheaper money. And this collision, it led to a really fundamental shift in how investors think about AI. So yeah, what we had here were two incredibly powerful forces just pushing the market in opposite directions. It was like a perfect storm. The fear of an AI spending bubble was this huge headwind, slowing tech down. But at the same time, the Fed's rate cut was a massive tailwind, pushing everyone else forward. The whole market was just caught in this giant tug-of-war.
And this brings us to the most important takeaway of this whole thing. The AI trade is evolving. The old way, the way things worked for the past year or so, was simple. You spend a ton on AI, we reward you. Your stock goes up. But the new way, it's completely different. Now, investors are demanding profits. They want to see a return on that investment. It's not about promises anymore, it's about profits.
So here's the final verdict. What we're seeing is a more mature market. Look, the AI boom is not over, not by a long shot. But the era of easy money for AI, yeah, that's done. Investors are becoming way more picky. They're not just buying the hype anymore, they're actually looking at the balance sheets. The key takeaway is that a clear path to profitability now matters most. The era of blank checks for AI, it's officially over. Which really leaves us with this final question, doesn't it? Is this the end of the AI gold rush, or is it just the end of handing out free shovels? Because what that Oracle sell-off really showed us is that, yeah, the demand for AI gold is real, but the market, it's no longer willing to just fund every single person who shows up wanting to dig. From now on, you've got to prove you actually know where to find the gold.